Good morning to everybody. I am Nicholas Bornois of Capital Inc., and I would like to welcome you all to today's webinar. Today's webinar is part of our closed-end funds and global ETFs webinar series, and we are delighted to have with us Mr. David Schassler. He is a portfolio manager and head of quantitative investment solutions at VanEck Securities Corporation. And David is going to talk about the very interesting and timely topic of real inflation risk requires real assets. The way that it's going to work is David is going to make a slide presentation. At the end of the presentation, he will address any questions that you may submit. Please, if you have questions, submit them through the Q&A button at the bottom of your screen, and David will address them at the end of the slide presentation. I'd like to thank the New York Stock Exchange for supporting this webinar. And in terms of disclaimer, obviously, this is for educational and informational purposes. It's not investment advice or advice of any kind, and Capital Inc. bears no responsibility for it. Delighted to have you with us, and I'm going to turn the floor over to David. David, again, thank you for being with us.
Thank you very much. And Taylor's going to share the presentation, so that's it. So, Taylor, if we can move forward here to slide 8, I'll jump right into the materials.
And I forgot to mention that this will be available as a replay. We already got a question on that, so go ahead.
Excellent. Well, first off, thank everybody for joining us. We really appreciate it. This is certainly a timely topic, but it's also a topic we've been discussing for some time. And I think we've been pretty consistent with our message really for an extended period of time. And that message has really just been that extreme monetary and fiscal policy comes at a cost. Unfortunately, that cost is higher inflation. That risk is being compounded significantly by Russia's invasion of Ukraine, which we will discuss as well. And we think it's particularly concerning because the central bank, the US Fed, we don't think is well positioned to really fight inflation. We think really at the end of the day that we're going to end up with an extended period of higher inflation. And if that turns out to be the case, we think people would need a very different investment game plan for the next decade ahead to be successful than the one that they had in the previous. The good thing about this is that if you position yourself well, if you own real assets in a sizable way, we think that you can actually perform really well in this environment. And then the last thing we're going to talk about today is an ETF that we have, which is the VanEck Inflation Allocation ETF, the ticker's RAX, RAAX. Really, that's a one-stop solution to fight inflation. So really just take those key inflation fighting assets, put them together in what we think is a really smart way, and give exposure right in a one-stop shop to inflation protection. So if we move forward here, we'll just jump right into the slides, and please ask any questions you can, and I'll address those at the end. So let's just jump into the first chart. And this is telling us that prices are far from stable. So CPI, the last CPI print we have in the United States is 7.5%. On the right, we're seeing core CPI, PCE. The bottom line is no matter how you measure inflation, inflation is significantly elevated. If we go to the next chart. One more ahead. Perfect. So this right here is a representation of the US CPI basket. So on the left side, you can see the shelter is the biggest piece, and then you also have commodities, energy, food, right? So obviously the situation that's developing over in Ukraine is putting significant upward pressure across the entire commodity complex, particularly food and energy. But what we're going to talk about right now is shelter. In the United States, we've structurally underinvested in new housing, really since the housing bubble burst in late 2008. So we've structurally underinvested in housing. And I think now we're starting to pay for that mistake. The shelter component of CPI is measured based off rents and rent equivalents. Now, rents typically lag home prices, that's a chart on the right, by 12 to 18 months. Now, nationwide, home prices in the United States are up around 15%, but the shelter component of the CPI basket is up around 4.2%. Point being is that we think that there's going to be consistent and significant upward pressure on the CPI basket as rents continue to climb to catch up with home prices. If you combine that with the much higher commodity prices that we've seen, particularly in the last couple of weeks, we think you're going to have a lot more pressure on the CPI basket. If we move to the next chart, please. Inflation and the money supply. One of our biggest pet peeves when people talk about inflation is they talk about it exclusively as a supply side issue. If you look back at significant bouts of extended inflation, they typically start on the monetary side. You saw it in Germany in the 1920s, the United States in the 1970s, and we pick up this chart then in 1960s, and what you're seeing is M2, money supply, relative to CPI. And the simple story here is this. If you blow out the money supply, you're significantly increasing demand. If you do that, you're going to figure out where your supply side vulnerabilities are real fast. Now, we think what's happening today is just history repeating itself over and over again. So in the 1970s, we used to back up the US dollar with gold, and then we stopped doing that. And that was a technical default. And that allowed us to significantly increase the money supply. So on this chart, you see a big increase in M2 in the early 1970s. Our supply side vulnerability then was our foreign dependence on oil. So when we increased the money supply, our dollars were worth less and less. We continued to purchase foreign oil, and that foreign oil got real expensive real fast. Interestingly, actually, in gold terms, the price of oil went down, but our devalued dollars were purchasing less and less. And what happened was that the price of oil caused cascading inflation to run through our economy, which then turned into a wage price spiral. And then we had the roaring inflation in the 1970s. We had other bouts of mild inflation. There was a small period of inflation in the early 1990s. Then we had 2008. So during the financial crisis, a lot of people got false confidence that you can increase the money supply as much as you want, you wouldn't get inflation. And they could point to the increase in M2 following the financial crisis, and then we did not have broad-based CPI inflation. Inflation is not just about creating money, it's about what you do with the money. If you create a ton of money, but you just dig a hole and you bury it in your backyard, well, you're not going to get inflation. But if you create a lot of money and you give it to people, particularly people that have a higher propensity to spend and save, well, you're going to get inflation. So after 2008, we printed a lot of money, but we used it to shore up our insolvent banking system. So we didn't bail out homeowners. We didn't go out and hand out money to lots of individuals like we did this time around. We used to shore up our financial system. And that gave us a really strong base to grow off of. So we got stock price inflation, we got bond price inflation, we got real estate price inflation. A really unfortunate result of that was we got a big discrepancy between the have and the have-nots in regards to the wealth divide between the rich and the poor. And then if you fast forward to today, the US dollar has been around for about 230 years. 1/3 of those dollars were created since March of 2020. This is the biggest increase in the money supply we've had. And it's not just that we increased the money supply. We increased the money supply, and then we gave it to people to spend, and spend they did. So if we go to the next chart, please. Consumption is booming. On the left, personal consumption expenditures on goods. On the right, personal expenditures on services. So people are spending, people continue to spend. We think that personal consumption expenditures on services pick up materially from here. Determining the path of COVID-19 has been especially difficult really for everybody. Now, hopefully it's behind us, but regardless, with vaccines, people's risk tolerances have changed. People are sick of being locked in. People want to go out and spend. They want to go to hotels. They want to go to restaurants. Well, it's really difficult to find people to work in hotels and restaurants right now. So we think that there's going to be a significant increase in demand for services, but we think that supply chains are going to continue to be evident there, and we think you're going to get more inflation. If we go to the chart, next chart, please. Globalization and supply chain issues. This is a very inopportune time to have a pandemic, big increase in the money supply, big increase in demand, because we are super dependent on our trading partners, which is the chart on the left. So that's the balance of goods and services. In the United States, we don't make a whole heck of a lot. So we import a lot of our goods, and we've got a huge demand for these goods. The chart on the right is showing us that supply chain pressures are huge right now. The situation in Ukraine and Russia has made this a lot worse. So remember when this first started, right? if you looked at the CPI basket was extremely elevated. Well, it started to become elevated because of one very narrow segment, really particularly used cars. And we were told, well, you can't make new cars because we don't have semiconductors. So used car prices are up a lot, but don't worry about it just because it's very narrow. And if you just looked through the lens of just the CPI basket, the idea that inflation will be transitory was very believable if you just looked at that in isolation, because it was a very narrow segment driving the CPI basket higher. Fast forward to today, and every element of the CPI basket is basically elevated above 4%. Point being is that the supply chain pressures started very narrow, but as the intensity and pressures continue to mount from the inflationary pressures, they became evident across the entire spectrum. That's what you're seeing today. That's why supply chains are so stressed as we sit here today. If we go to the next chart. When you hear central banks and economists talking about inflationary pressures and what's the next step, what we're talking about is entrenched inflation. Once inflation sticks around for a while, it changes consumption patterns, it changes behavior patterns. One of the biggest things that starts to happen during periods of higher inflation is people demand higher wages to maintain their standard of living. We demonstrate that with two charts here. The chart on the left is showing the cost to hire somebody. That's wages, that's benefits. So if you want to hire somebody, you're going to pay more. The chart on the right is showing nominal wages net of CPI. So these are real wages. So people are making more money on a nominal basis, but their spending power is going down because it's being taken away from inflation. Now, this is one of the few times in American history where the labor has the power. Point being is that people are going to continue to ask for higher wages. This is the dreaded wage price spiral. This is what happened in the 1970s. Once this starts, it's very hard to stop. If we go to the next chart, please. So the way the wage price spiral works is really simply this. Your spending power goes down, you go to your boss, you say, listen, I need more money. Because labor has the power right now, your boss will most likely give you the money. Now, that cost is then passed to consumers. That causes inflation. Oh, by the way, the employee now has more money to spend. That's going to cause inflation. And then it happens again and again and again. And these upward pressures on wages continue to manifest themselves into more inflation. That's the dreaded wage price spiral. That's what economists are worried about. That's what this chart's showing. This is basically a quantitative illustration of the wage price spiral. And what it's showing is that there's a strong relationship between wages and inflation, particularly during periods of higher inflation. So you saw that connection in the 1970s. You saw it in the late 1980s, and the mid 2000s, where there's a big spike in correlation between wages and inflation. Now, the last bullet point here is today, and you can see the big spike in correlations now. We think that that's just getting going. And if that's the case, that would mean a much longer runway for inflation. If we go to the next chart, please. This specifically addresses Russia. So Russia is a commodity powerhouse. They are a key player across the entire commodity complex. The problem is that there was significant commodity pressures, shocks prior to the invasion. This is purely adding gasoline to the fire, what's happening right now between Russia and Ukraine. If we go to the next chart, please. Oil prices and recessions. This is showing the relationship between surges in oil prices and recessions. Now, not every recession is caused by a spike in oil, but every oil spike contributes to recessions, and that's what we're seeing. So 1990s, you've got a big spike in oils, then you had a recession. 2000, big spike in oil, then you had a recession. 2008, big spike in oil, recession. 2020, at one point we had negative spot oil, right? Now we're up, pick the time, right? So 115, 120 per gallon. Excuse me, per barrel. So you have a situation here where oil prices are significantly contributing to a decline in economic activity. If we go to the next chart. War and inflation. So high inflation typically occurs around wars, and that's what you're seeing. So you've got World War I, World War II, Korea, Vietnam, the Gulf, Iraq, and now you've got the Russia, Ukraine. And you can see here that during war times, there is a spike in inflation. And that's what we're seeing here. This is particularly concerning now for 4 reasons. The first is those already existing commodity shock pressures in the markets prior to the invasion. That's the first reason. The second, as we just went over, Russia is a commodity powerhouse. The third, the idea of sanctioning, right? Economic warfare is very inflationary, right? That restricts supply, that causes more inflation. It's particularly concerning as well because Russia may escalate this further by limiting further supply, and we know how important they are. And the last thing is the idea of weaponizing the US dollar, right, has long-term implications on the US dollar, puts long-term upward pressure on commodities, specifically gold. If we go to the next chart, please. The Fed is not well positioned to fight inflation. Powell testified recently that he would do whatever is possible, whatever needed to be done to fight inflation. We do not think that that's very believable, and we'll cover why. The last time we had an inflation situation as bad as this was the 1970s. During that time period, it required Paul Volcker to increase short-term interest rates to 20% to fight off inflation. That caused a pretty nasty recession. But back then, the debt to GDP ratio was 30%. Today, it's closer to 140%, around 137%. This is the classic example of the doctor killing the patient to fight the disease. If they were to get very tough on inflation, we believe it would cause a very nasty recession. And then you have to ask yourself, well, what's worse, right? The devastation that would be caused by putting that much pressure on the economy, or letting inflation, the supply-demand imbalances to work themselves out over an extended period of time. The last time that we had a period of rate normalization was 2015 to 2018. During that period, we got short-term interest rates up to 2.5%. When they did that, it became pretty clear that that was too much for the economy to bear. You started to see stress cracks. Economic activity started rolling over. The Fed recognized that and walked down short-term interest rates. The S&P 500 went down about 20%. And rates went back down to around 1.5%. Then the economy got completely sucker punched by COVID-19, and rates completely fell to the floor. At that point, the debt to GDP ratio was around 107%. So we don't think it's very realistic that we could really fight inflation directly by materially increasing interest rates without having profoundly negative impacts in the economy. And if that's the case, we think there's a much longer runway for inflation. We think we stay in this period of negative real rates. We think that we're more fiscally prudent. And over the long run, we allow the supply-demand imbalances to heal, which means a longer runway on inflation. And if that's the case, it would require much different investments going forward. If we move to the next slide, please. Impacts on corporations materializing. Inflation is something that challenges most businesses. So as inflation picks up, at first, it's easier to deal with. You can do things to control inflation the best that you can. You can get very tough on costs. You can break out your microscope. You can figure out where you've got excess costs. You can trim those costs back. The term shrinkflation has become popular recently. So if you sell cereal boxes, put a little less cereal in the box, right? If you sell dog food, lower quality meats, more fillers, right? There's things that you could do up front that are clever. But eventually, as inflation continues, you're getting squeezed everywhere. Transportation costs, wage costs, input costs. As that continues, it takes a big hit on profit margins. And then you typically see a big bifurcation between inflation beneficiaries and everybody else. So there's 3 charts here. The first chart on the upper left, this is the number of times somebody, an S&P 500 company, cites the word inflation during an earnings call. So these are corporations sounding the alarm, telling us that inflation is going to be a problem going forward. The chart on the right, profit margins peaked out early last year. They've been falling. This is because profit margins are being pressured by inflationary pressures. PE ratios contracting. PE ratios contracting due to falling earnings. Obviously, the geopolitical tensions over in Ukraine are not helping the situation. Interest rates have been attempting to adjust to the new inflation regime. As that happens, it puts more downward pressure on valuations, particularly longer duration assets like growth stocks. Now on the bottom, this is really interesting. So this is energy. This is showing you year-over-year changes in profit margins. So energy materials, two classic inflation beneficiary segments of the market, have the fastest growth in profit margins, but they're also the cheapest, which are those teal dots. So we think this is one of those rare opportunities where the fastest area, the fastest growing segment of the market is actually the cheapest. And we think that that's further evidence that the rotation is just in the early stages. If we go to the next chart, please. So this is when we segment to, well, what do we do about it? The good news is that during periods of high inflation, there's specific assets that have historically done very well during periods of high inflation. Historically, and now, during periods of high inflation, very simply, real assets prosper, traditional assets suffer. And you can see here on this chart, as inflation goes higher and higher and higher, the real returns on equities go down and down and down. Fixed income is disproportionately impacted. You lend somebody money for 5 or 10 years. When you get that principal back, it's going to be worth a lot less because of inflation. Oh, by the way, interest rate risk is becoming more and more apparent as interest rates attempt to readjust to the new inflation regime. Commodities respond immediately to supply and demand imbalances. That's clearly what's happening right now. Gold eventually responds as that store of value asset. We think that that's just getting going. If we go to the next chart, please. Inflation during the mid-2000s. So this was a much more mild bout of inflation, and it completely went away once we had the financial crisis. But it's important to look at. And really it's important to look at is because unlike the 1970s, we've got a lot more index data. So we can really slice and dice real assets and broaden out from just commodities and gold to natural resource equities, REITs, infrastructure. Really simply, the top performers during a period of high inflation are commodities, gold, and the companies that benefit from higher commodity prices and higher gold prices. But there's also other real assets that perform well, maybe not as good as those, but generally speaking, they perform well, especially relative to traditional equities. The first being REITs. So REITs benefit from higher property values, as well as higher yields off those properties. Infrastructure companies are just really good at passing along inflation without absorbing it, right? So they can pass it along to their consumers really quickly, maintain profit margin. But again, I'll say it, the top performers during periods of inflation, historically and today, are commodities and the companies that benefit from higher commodity prices, natural resource equities, gold bullion, gold equities, and commodities. If we move to the next chart. Gold, the second half team. One of the biggest misconceptions is the understanding of when gold performs. A lot of people loaded up on gold last year. They got the macro call right, but the implementation of that call hurt them. So gold typically lags commodity prices in the early stage of the inflation cycle. So what you're seeing is the first half of the inflation cycle of the 1970s, the first half of the mid-2000s, and you're seeing the same thing play out today, where commodity prices immediately respond to the supply-demand imbalances. For gold to work, because it does not have the utility that the commodities have, people have to seek it out as a store of value asset, which means they have to believe that there's an inflation problem. They have to believe that's not transitory. For that to happen, you need an extended period of inflation. Keep in mind, inflation, high inflation is an extreme event. It doesn't happen often. So the knee-jerk reaction when you're first faced with something you most likely have never dealt with before is to assume it's just going to go away. And if you assume it's just going to go away, well, there's nothing you have to do about it. But if we move to the next chart, this is the second half of the inflation regime in the 1970s and the mid-2000s. At this point, you're sick of people telling you that inflation is not a problem. Everywhere you go, you're paying more. You're constantly looking at your statements. You're seeing the value of your portfolio go down and down. At this point, you understand that there's an inflation problem. It's undeniable. You seek out a store of value asset. Once you get to this point in the inflation cycle, gold has historically been the top performing asset. We think gold is just getting going today. If we go to the next chart, please. Chart on the right showing us that gold does best with negative real rates. Because historically speaking, when you look at gold bullion and you look at high yielding assets, there's an opportunity cost to own gold. That's not the case with negative real rates. So it just creates an opportunity for gold to really just do that much better. Oh, by the way, the chart on the left is showing that we've got the deepest negative real rates in the United States. And if you look at real rates really across the globe, you'll find that most of them are deeply negative. So just to summarize the statements on gold, we think this is one of the few times where gold's this attractive on a relative perspective relative to the other assets. Negative real rates, sky high inflation, big geopolitical tensions, and the chance of a policy misstep from the Federal Reserve is really, really high as they attempt to tighten policy into a declining economic activity regime with the war going on, with what we believe to be the start of a commodity super cycle. So if you put all of that together, we think that gold will be a top performing asset going forward. If we move to the next chart, digital assets and gold. VanEck, the firm that we work for, has been a big investor in gold really since the origins of our firm in 1955. So we're proud to have a lot of the largest institutions as investors in gold. And speaking with them, right, we understand that people are considering digital assets as an alternative to gold. So where people may own a lot of gold, they are starting to diversify a small segment into digital assets. And we think it really makes sense for three different reasons, right? And those are related to the comparisons as a store of value asset between gold and digital assets, specifically Bitcoin. So what are those comparisons? The first is finite supply. Only so much Bitcoin can be mined. Only 21 million Bitcoin can be mined. After that, you cannot do any more. And only so much gold can be extracted. So there's both finite supply for both gold as well as Bitcoin. The second is exchangeability. I can sell my gold, I can sell my Bitcoin whenever I want, convert to dollars, and then purchase whatever I need. And then the third is you cannot counterfeit gold, nor can you counterfeit Bitcoin. So those classic litmus tests of is something a store of value asset, we think pass muster for Bitcoin. Now the pushback we'll often get here is, well, how can something be a store of value asset if it has such a high volatility profile? We actually think the volatility is to your advantage, meaning that you can own a very, very small amount of Bitcoin and potentially get a lot of upside if Bitcoin performs fractionally as well as it has historically. So we think of it as a diversifying asset with a lot of optionality to the upside. And the last thing that I'll say about this really simply is that historically, denying disruptive technology, specifically disruptive technology that has institutional adoption, has been a losing proposition. So we think that generally speaking, digital assets, specifically Bitcoin, is here to stay, and it should be a small piece of a portfolio, albeit very small. If we go to the next chart, please. At this point, the conversation typically pivots to, well, how much do I have to own of real assets in a portfolio to really get protection during a period of high inflation? The first thing I want to point out is that we had the longest period of growth outperformance that was fueled by low interest rates, low inflation, and low growth rates. So you had a period of time where growth massively outperformed value. That's really important because most client portfolios, because of that, right, are benchmarked to the S&P 500 and the other indices, have an extreme overweight to growth segments of the market, which are the most vulnerable because these are long duration assets during a period of higher inflation. So really, regardless of your view on inflation, right, if you think inflation is going to normalize really, really quickly and fall back down to those low levels, you've got that covered. But what if it doesn't? And if it doesn't, most people don't have nearly enough protection. We did a study and we found that during the 1970s and mid 2000s, in aggregate, when you look at the periods of high inflation, you really need 10 to 15% exposure to direct real assets, right, in order to generate a very modest real return hurdle of around 3%. So at this point in the inflation cycle, given how high inflation is, personally, I'd be very uncomfortable with less than a 10% allocation to real assets to fight inflation. So if we move to the next chart, please. This is really just a summation of everything we spoke about before we kind of give you a segue into our inflation allocation ETF, RAX, RAAX, just to kind of give you our representation, right? Our expression of what we think is an optimal basket of inflation fighting assets. But my summary on the macro backdrop and the real assets is this. We've had extreme monetary and fiscal policy, which led to a surge in demand, which was then met with significant supply chain issues, which has then caused the inflation that we have right now. This inflation is being compounded significantly by the events in Ukraine, right? And because of Russia's importance as a commodity powerhouse, we're seeing what's happening in commodity prices, which is going to further add to the inflationary pressures. We think 10 years out from now, if we look at the average rate of inflation, it will be materially higher than it was in the previous decade. Keep in mind, the previous decade saw 1.8% level of inflation. That is significantly below the long-term average. Since the inception of the CPI, the average CPI rate was 3.2%. Over the last 50 years, it was 3.5%. So if inflation just goes back to long-term averages, that would require a very, very different game plan for going forward. We think early stages for a value rotation. Specifically, we think real assets will lead the market higher in that regime. If we go to the next section to talk about the inflation allocation ETF. So if we just move one forward, I'll give you a quick summary of the product, and then we can go a little bit further into recent performance. But basically, really simply, this is a one-stop shop to fight inflation, right? That's what REX is. It's a one-stop shop to fight inflation. There's three reasons why. The first is it gives you exposure to those key inflation fighting assets in one vehicle. So all those assets that worked in the 1970s, the ones that worked in the mid-2000s, the ones that will lead the market higher, those are well represented in the allocations. The second is it's risk management, which means that's well diversified. So it's not as much about picking your individual spots as of getting broad diversification, because it's very difficult to time which segments of the real asset universe are best positioned to perform during the different cycle, during the different levels of inflation. And the third is, which is what this slide is, it adapts to different inflation regimes. So let's look at this slide. During periods of high inflation, like we covered earlier, your top performing assets, commodities, they respond immediately to supply demand imbalances. Natural resource equities. These are companies where their cost structure rises with everybody else's, but their revenues go up significantly as they benefit from higher commodity prices. And gold benefits eventually as that store of value asset. Now, there's other real assets that perform well during periods of lower inflation. REITs, infrastructure, and MLPs. So the way that this fund works is really simple. It uses relative momentum and allows the portfolio to drift towards the assets that are most in favor. So right now, you'd expect us to be the most overweight commodities and natural resource equities, and we've been that way for some time. And we also have a pretty large allocation to gold, because those are the segments that are currently leading the market higher. Alternatively, if we go into a period of lower inflation, you'd expect us to pivot towards REITs, infrastructure, and MLPs. During those lower inflation regimes, those are typically the segments of the real asset universe that perform the best. But right now, we're clearly in high inflation territory, and because of that, we are most overweight the assets that are best positioned to perform that regime, and those are the ones that are. If we move forward to the next chart, please. These are the top inflation fighting assets. So I'll cover them from left to right. Financial assets, gold bullion, gold equities, a very small slice to digital assets, specifically Bitcoin, so exposure to Bitcoin. Resource assets, commodities, and the companies that benefit from higher commodity prices. Income generating real assets. These are the real assets that you get paid well in the form of a yield to own. Infrastructure, REITs, and MLPs. If we go to the next chart, please. This is our current allocation. I see three major takeaways. The first, you're getting exposure to the key inflation fighting assets. That's what you see here. These are the real assets, again, led the market higher in the 1970s, led the market higher in the mid-2000s. Those are the ones that are leading the market higher now. So commodities, natural resource equities, gold, that's a diversified basket of real assets. The second, we are most overweight the assets that are leading it higher. So the dark blue, which are the natural resources, commodities, and natural resource equities. And the third, there's clearly an expression being shown here, right? We are clearly expressing a view towards commodities and natural resource equities, which is why you see a significant overweight. But you can also see that we're well diversified, and that's point number three. So yes, there's a view, and yes, that view is being expressed through a commodity and natural resource equity overweight, but it's well diversified. This process is well diversified because we're using an optimization process that's measuring how much contribution of volatility is coming from each segment of the market, because although we want to express a view and we want to be overweight the assets that are most in favor, we always want to maintain strong diversification. And if we maintain strong diversification, that should provide a very stable return profile, risk and return profile over time. And if we have a stable risk and return profile over time, that would allow people the comfort to give it a larger allocation within their portfolio. So if we move to the next chart, and after this, we can stop and take questions. Now, how is the fund performed, right? We are super critical of everything that we do, and it's hard to be critical of the strategy recently because since inflation's been a problem, it's been overweight the right assets. So when people ask, well, how is the strategy done? Well, inflation's up a lot, right? And the fund's up multiples of inflation, right? It's performing extraordinarily well since inflation's picked up. As we sit here today, outperformed the S&P 500 by over 20% year to date. So we are very happy with the performance. The fund's been overweight the right places to be, overweight commodities, commodity-related equities. It's been increasing exposure to gold. Gold's been performing well recently. So generally speaking, we are very happy with how this solution has performed. Very, very excited. So if people are worried about inflation, as they should be, and thinking about solutions, because there aren't a lot out there, we would hope that they would consider RACS, which is the VanEck Inflation Allocation ETF. So I can pause there, and I see the questions coming in, so I will just go through and take a look at this. Bear with me 1 second. So one of the questions that I'm receiving right now is, where do you view inflation to be, 5 years from now? We don't peg inflation and try and estimate where exactly inflation is going to fall out. So we're not saying inflation is going to be at 5% or 10% 5 years from now. We think the risk is clearly to the upside. Again, we think that we had a period of extended low inflation, and we think that that's going to turn, right? We think that we're going to be in this elevated inflation for an extended period of time. And as such, we think people should have protection, but we're not saying that inflation is going to be 5, 10, or 15%, 3 or 4 years from now. What we're saying is higher for longer. And if so, you should consider real assets. We're getting a lot of questions about the presentation, so I'll let somebody from the product management side follow up and tell us if we can have those charts shared. We have a question: how often do you adjust the mix of real assets within the portfolio? So we do adjust the allocation to real assets over time. So because these segments of the market typically perform for extended periods of time, so commodities have now been leading the market higher now for, we're going on the second year of that, natural resource equities, we don't make rapid changes in the allocations. Typically speaking, we typically don't adjust the portfolio by more than 2% over any rolling 30-day window, because we don't want to abruptly move between allocations. We can during extreme events, but we typically don't turn the portfolio over that often because we want to benefit from these long-term trends and not be super price sensitive to what's going on in the market right now. Can you explain the December 28th price decline in the chart? So that's NAV performance, and that was a distribution, but it was a distribution based off of the yield. So there are real assets that generate yields in this portfolio, and as such, you should expect a distribution in this fund each year. So REITs, infrastructure, MLPs, these are typically higher yielding assets, and we pay out those gains once a year. We have a question on Russia and Ukraine. So if Russia and Ukraine invasion lasts longer, do you think that inflation continues to rise throughout the year? We think that the situation in Ukraine is very dire, obviously from a humanitarian perspective, but clearly from an inflation and economic perspective. We had a bunch of charts that showed that it cannot be understated how important Russia is in the commodity complex. The risk here is that if we further suppress and further to put sanctions on Russia, that they escalate this, and they escalate this by limiting supply. And if that's the case, it will put more upward pressure on commodity prices. Commodity prices touch everything. They cascade through the economy. And if that's the case, we'd expect higher for longer. The unfortunate part when before this conflict even started, there was a lot of commodity pressures. So this is really adding a lot of gasoline to the fire. So with that, I'll stop. There's a lot of questions and we'll follow up afterwards, but I think I covered most of them. A lot of these are repetitive. So I'll stop there and let Nicholas jump in.
Well, David, I'd like to thank you very much. Very interesting presentation, extremely timely topic, and you know, all the details that you shared are spot on what is happening right now. So thank you very, very much for sharing your insight with us. I'd like again to thank the New York Stock Exchange for supporting and sponsoring this webinar. And I just wanted to thank you. You had great attendance, an avalanche of questions. So that indicates that the webinar was spot on. So thank you very, very much.
Thank you so much. It was a pleasure. Enjoyed it. Great questions. And if we missed any questions, we'll follow up afterwards. Thank you so much.
Thank you.
Have a good one.